Good morning, everybody. We're just going to give it another 30 seconds. Participants are trickling in right now. All right. Welcome to the December 7Bridge webinar. I'm Justin Ferraccio, and with me is Chuck Eberly.
Hey, good morning.
Just a kind of quick reminder of how this works in the cadence. We do monthly webinars to talk about economic topics, what's happening in the stock market. We'll have guest speakers from time to time, CPAs, estate planning lawyers. We had a cash management tool last meeting. So this is not meant to be a replacement for your meetings or discussions with Chuck and I and the team. This is just some additional information that we're doing instead of a newsletter. As always, feel free to invite friends and family, anybody else you think might find some value here. So I'll share my screen. We'll go through the webinar. If and when you have questions, and we encourage questions, you can send them directly to the chat window. They come to me. They come as anonymous. Well, I know who sent them, but no one else on the call will see your questions. If we get to all the questions, great. If a question is specific to your individual situation or we run out of time, we'll call you directly and we'll discuss them. And so with that, we'll go ahead and kick it off. Okay, so today, we'll quickly go through the market performance slide year to date. We're going to talk about tax loss harvesting, and then Chuck is going to talk about 2025 in review and look ahead at 2026, and then we'll get into Q&A. So it's been a pretty wild year. Lots of volatility. Even the last 5 days of trading have been, pretty volatile. But overall, it's been a pretty remarkable year. We know we're seeing now almost 13% gain in the Dow, close to 15% in the S&P 500, almost 18% in NASDAQ, which is more tech AI focused companies. There's been a big increase recently in the Russell 2000. That has been up about 5% in the last month. Those are small and mid-cap companies. Equal weight S&P 500 is just a different way to look at the S&P. So the S&P that's up 15% is weighted by market cap. So it takes the biggest companies and gives them a bigger portion of the pie. So for example, NVIDIA is 8% of the S&P. So 8% of those returns are attributed to that 15%. Whereas the equal weight takes all 502 stocks in the S&P and weights them all exactly the same. So it gives you kind of a more balanced look at how all sectors are performing in the economy and how all companies are performing. And then lastly, bonds are up 3% for the year. It's been kind of a slight pullback over the last couple of weeks, but all in all, a reasonable year for the bond market. So we're going to talk about tax loss harvesting, which is where Chuck and I have spent a lot of our time in the last couple of weeks, and we'll continue to be spending our time there, hopefully through this week. And we're not doing this during the holidays is the goal, but we get a lot of questions about what is tax loss harvesting, how does it work, why is it important? So we thought it would be good to spend a few minutes going through it, answer questions as they pop up. So tax loss harvesting is realizing losses to offset capital gains, while at the same time keeping your market exposure on. So we can use those losses to directly reduce taxes today, defer future taxes, and it allows your capital to compound more over time. And so how does that work? If we have a lot, say we have a position that's at a loss, and we want to use that loss this year, we can sell a position that's down $5,000 and then sell a position that's up $5,000. And then we have a tax neutral event. Oftentimes, we can store losses or they roll forward forever. So if we took $30,000 of loss in the account this year and didn't want to take any gains, we can roll that loss forward. Say we take another 30 next year. All of a sudden, 2027, we have $60,000 in losses that we can now use to offset gains if positions have gotten out of line. If NVIDIA has become 5% of your portfolio, we can trim it back without causing you any tax burden. Individual losses we can capture across multiple holdings, even when the market's up. And we'll get into that in more detail in the next slide when we're comparing how this works versus ETFs. ETFs, exchange traded products, which are pooled vehicles, you can only sell them at the fund level, right? So individual stocks create much more opportunities. And then lastly, mutual funds are the least tax efficient. And we'll talk about that again here shortly. But a good way to think about this is, say if you have a pooled vehicle like an ETF, maybe it's an S&P 500 ETF mimicking the S&P 500 index, that might be up 12% this year, right? But inside of that portfolio of 500 stocks, there's things that are down, but because the whole ETF is up, there's nothing you can do to be tax efficient, right? Whereas, we're building individual stock portfolios with 50, 60, 70 stocks in those positions, right? We're still getting great gains. We're actually outperforming the S&P this year in most of our equity portfolios, but with 30% less risk. And at the same time, we have, so there's some healthcare companies that are down this year. There's a couple tech companies that are down this year. We can take those individual losses, right, and sell those pieces of the portfolio, buy something similar, or buy, a different index for 30 days, and we can buy those stocks back. So we can become very tactical, extremely tax efficient with how we manage the portfolios, whereas mutual funds and ETFs don't really allow that. And mutual funds are actually the worst because when you buy a mutual fund, you're assuming the cost basis of the stocks owned in the mutual fund when you buy. So if you bought a mutual fund today that's owned Google for 15 years, they're going to have hundreds of percent gain in Google. Even if you've never seen a dollar gain in Google, if they sell some at the end of the year to rebalance their portfolio or they're, changing positions around, you're going to get distributed capital gains on a position that you never made money on. And so it becomes extremely tax inefficient. It can be a good vehicle for people that have less money, that are looking for diversification. But Chuck and I feel strongly, and I think you all do too, because you're working with us, that the power of owning individual stocks, we can be tactical with sector allocation. We can, pivot between sectors and companies quickly, but we can be much, much more tax efficient, which leads to outsized returns over time.
Very true.
Yeah.
It's all about after-tax return. So we try to be as efficient as we can. And like Justin said, we're spending a lot of time now. We're actually going through every single relationship, looking at tax loss harvesting. Kind of just to give you an idea, we look at it as, if we can get $1,000 tax loss, we'll go ahead and sell that. Either use it to offset gains this current year, or we can use that, that loss will carry forward. You're allowed to use up to $3,000 of that without any other corresponding gain. So 3,000 reduce your taxable income, not a big deal, but becomes a big deal. Say next year, we have some gains. We want to positions that are concentrated. We want to manage that. We can take the gains, use those losses that we took this year to offset those gains. Justin asked, we're working on this early this morning, and he said, what would it be like to do, in a big down year? And, kind of reminded me of 2008, basically the whole market's down. We took all the losses in 2008, and many of you who were with us, you had a loss carry forward that we've used for, 10 years that you never paid any gain. So it's very powerful. It's something that, that we implement, and we wanted to kind of highlight it, especially if you start seeing more activity than normal in your account. That's what's going on. And this is just in taxable accounts. So, there is no tax loss harvesting in IRAs. So doesn't do any good. So we don't do it in there.
Perfect.
Okay. My turn.
Your turn.
So let's just go back and review, what happened this year. So you think back to the first quarter, everything was, kind of all systems go. Market was up nicely. There was a big bump after the election. And then the tariffs got announced in April. And that was a concerning time, without a doubt. The S&P 500 was down 15-ish.
Yeah, about that.
15%. The NASDAQ was down 20. And it appeared that the tariffs were gonna, knock everything off track at that point. And we fielded a lot of calls. People were concerned, as they should have been. And then when people looked at their accounts, I think they saw, the market's down 15-20%, but my account's down 7. So it really, I think, highlighted the fact of diversifying by sector of the economy. It works. It worked during that time in April and during COVID and other bad times. But the hardest hit sectors were tech, financials, and energy. There was other sectors of the economy that were actually up. So we felt very well prepared for that. And I think the results prove that out. Then you kind of fast forward to the rest of the year. AI companies kind of, a lot of performance came from there, was kind of concentrated. But if you look at your account, and I've been doing some reviews with people, we've been going through this. If you look at our performance portal, which is Orion, some of you have it, all of you have the ability to look at it. If you want to look at it, our performance portal on Orion, reach out, we'll get you on there. But you can go through each security that you have and actually see what contributed to performance, what detracted. So yes, the AI companies did well, but you look at your portfolio, there's other companies in there, Cummins Engine and Caterpillar, many companies that on the surface don't appear to be AI, but like Caterpillar, they're building data centers, all that equipment that's being bought, used, serviced, participating in that. You look at financials, JP Morgan, which virtually everybody owns, that's up very nicely, about double what the market is. Some of the healthcare companies are up greatly. So Justin and I were looking at this morning. If you look at the S&P 500, and that's, we don't subscribe to this, but many people do, the top 10 holdings account for a great percentage of that. And it kind of takes away from all the rest of the great companies. Caterpillar, that's up 60%.
Yeah, 70.
Yeah, 60-70% this year. If you own the S&P 500, you have 0.5% of your money in there. Where you look at, we end up getting a 4 or 5% greater weighting in these other companies. So our performance is coming from many places, not just tech. So going to the next kind of bullet point, the market broadening, we're starting to see that now. Last couple of weeks, we're starting to see kind of cracks in the whole AI, the capital expenditure that's going on there is a question. The visibility of profitability on the spend on AI is in question, and we're starting to see some pressure there, but we're starting to see other sectors of the economy participate more. So if you look at this year, consumer discretionary companies haven't done well, like your Lowe's, Amazon, materials, energy, industrials. Many of those companies, consumer staples, have underperformed the market. We're starting to see that sector participation starting to broaden out into these less performing sectors. You look at tech, financials, utilities, great performing sectors this year, but we're starting to see that broaden out. Okay, as far as what to expect next year, or what we're looking at for next year, is continued market sector participation or broadening out of market performance coming from different places than just AI and tech. So what we're looking at for you is monitoring your sector allocations. And I'm getting more and more phone calls about um, people kind of weary of this market, that comments like, seems very expensive. It looks like it's going to, like we're gonna have a correction. What we prefer to do is, instead of trying to guess when that correction might happen, is look at your sector allocations, make sure that we aren't overexposed or underexposed. And that's what will hold us together if something bad does occur, and it will at some point, that we're ready for it, that you're less impacted by it. And that's the main way we can manage risk, is look at these sectors. So we want to participate in this continued market broadening out. You know, AI companies, I don't expect a repeat of 2025 and 2026 for them. It doesn't mean it's over, but I think if you think back to the dot-com time, late 90s, anything that had a dot-com in their name went through the roof, whether they made money or not. You think back to some of those companies are not even around. AOL, Yahoo's still around, but not a real player. And a lot of those companies, were huge returns in the 90s, disasters in the 2000s. I think one thing I look at is Cisco Systems. That thing went through the roof in the 90s. That stock has not returned to its highs in 2000, even today. So, it kind of proves the point. As you see these AI companies move up and down, you see a little bit of movement. It doesn't necessarily mean that, it's a great buying opportunity. What we want to look at is, how much exposure do you have? If you have enough and the thing goes down a little bit, we don't want to pile in on it and kind of knock the risk profile at a joint. Key economic indicators, which we go over a lot in these calls, those service and manufacturing surveys, unemployment numbers, interest rates, all these things that we're watching. There's no flashing red lights. I would also say that it's not a blaring green light if everything's okay. We're kind of still in that, it could go either way. We think it's going to go more to the positive than the negative. Looking forward to the first quarter, we think a lot of good economic, as far as earnings growth and profitability and capital expenditures, all those things look okay at this point. So we don't see any flashing red lights, but we do want to continue to monitor risk profiles and do that through individual stock concentration and sector concentration.
Yeah.
Anything to add there?
No, just to kind of add on a little bit, it's, Chuck and I are really good at this. We spend a lot of time doing this. No one knows what direction the market's going to go, when it's going to go a certain direction. So, we were getting calls after the election, we were getting calls during tariffs that, people with fears, concerns, wanting to try to time the market to sell and buy back when things look better. We're very convicted it doesn't work like that, right? If you would have made those decisions this year, you miss out on 10 to 15% return, right? Because when the market does change, it can happen very quickly. Things look bad during tariffs, but 4, 5, 6 weeks after tariffs, the markets were back to even, and then they were up 15% from there, right? So this is why we focus so hard on monitoring sector allocation, monitoring risk and exposure to individual stocks, so that we can withstand storms when they do happen. And like Chuck said, it will happen again. We will have a market downturn. We probably will have something at some point more substantial than tariffs in terms of duration, but that's okay. We're ready for that. We plan for that. We build for that. And when it does happen, it's just really important not to try to time the market, because when you do try to time the market, you may get it right once or twice, but if you look at averages of people trying to time the market, they average 2 or 3% return per year, because you just can't be right in those decisions. There's, many people on Wall Street making millions and hundreds of millions of dollars a year, and they also don't know what direction the market's going, right? So it's educated guesses, and it's us building portfolios that are bulletproof and can withstand anything that comes our way.
I think one thing that happened this year, you look at the portfolios, look at your portfolio, um, you know, we don't have like a model and everybody's the same. So performance in each of your households is a little bit different than, maybe another one. But I think on average, if you just focused on the equity part of your portfolio, we've seen about an average of a 16% total return there, which is more than the S&P. And the only reason for that is we lost less money during the tariffs. And we were able to catch up much more quickly, which, you basically got a better return by taking less risk. And that's what we're trying to do. Participate on the upside when it's happening, but really manage the downside when that happens. And then in the end, you get a better result by taking less risk.
Nice.
Yeah.
So now we'll go to a couple questions, and then we'll let you get on with your day. So, Chuck, can you talk a little bit about bonds, what you see have happened in 2025, and where you think bond yields are going to go in 2026?
Yeah. So as most of you know, bonds, when interest rates go higher, the price of bonds go down. So it's an inverse relationship. Interest rates go down, the price of bonds go up. And I think, in 2022, the bond market was down 22% when rates started going higher. Justin showed the bond index is up about 3.1, right? So I think one thing that's true about bonds all the time is that bonds have a tough time beating inflation. Really, with interest rates where they are, the bulkier return is going to come from the interest rate that you earn, and that's about all there is. Could interest rates go lower? They can, but I don't think we're going to see, post-COVID interest rates return, zero interest rates. So, for bonds to really get a big return, we need interest rates to drop a lot. The Federal Reserve has been lowering interest rates. We got those two reductions. But the longer duration bonds, 10 years, 20, 30 years, they haven't budged. They've actually gone up a little bit. So there isn't a direct relationship, necessarily with the Fed lowering interest rates and what happens to your bond investments. So what I would expect going forward, kind of best case scenario, you get your interest. We kind of look at bonds as a place to have some of your money that's not as volatile as the stock market, but we don't look at bonds as a place that's gonna outperform stocks over time. So if you're trying to most of us are trying to get a good solid return, beat inflation. If you have a lot of money in bonds, you have a hard time doing that. So kind of we look at it as a balanced approach. Bonds have their place, but I don't expect big things out of bonds.
Yeah, and we should get one or two more rate cuts in 2026. So I think we will expect the 10-year to come down over time, which would be a good thing for bonds.
And mortgages.
Yeah, and mortgages. Correct. Okay. Someone's asking about our thoughts on solar and green energy. So I can chime in on that one. It's the big beautiful bill, which came out earlier this year, really hurt green energy, really hurt solar. Basically, the federal subsidies came away from a lot a lot of businesses in those sectors. So I think over time, they will do well. They'll be okay. It seems to me the technology is not really there yet for solar or green energy to be profitable enough for companies to continue to chase it without subsidies. Now, companies will continue to chase it and, build better technology. That will continue to happen. But I think, Chuck and I are of the belief that over time, if and when we get to green energy, solar energy, and it's efficient and really, really scalable and doable, the big energy companies will be the ones to do it. It'll be Exxon, it'll be Chevron. Unfortunately, or fortunately, depending on where you kind of sit with those companies. I know a lot of people don't like those companies, but they're not going to sit by the wayside and become dinosaurs and not evolve with the time. Those Chevron and Exxon are constantly buying green energy companies. They're buying the technology. They're either shelving it or they're going to try to, make it better over time and make it profitable. But when and if it becomes more profitable than traditional energy, those companies will be probably at the forefront of it. If you have any different thoughts.
No, I agree. I think what, we're screening companies for, do they pay a dividend? Do they grow them every year is the core. And almost every green energy company doesn't pass that test. So I think when the technology and everything's scalable, that's when their earnings will be more stable and growing, and then they'll be able to pay a dividend. They'll be able to grow it every year. I think that's when we'll start to be looking at that to be in the portfolio. So it's kind of a, we don't look at it as what do we think about it. We look at what's happening, what are they doing? Do they have the earnings? Do they have the earnings growth to grow the dividend every year? And it, to us, that's something that doesn't, can't be hidden or created. They have to be doing it. And
Yeah.
that's the test that we think they need to pass.
The last question's kind of a Christmas present from one of our clients, but asking if we're taking new clients at the firm right now, which is interesting because Chuck and I have gotten this question twice over the last month too. And I don't know why we get that question, but we are taking new clients. We are pretty selective about who we work with. We want to work with people like the people on this call. It's important to us. It's a good fit from our side, a good fit from their side. That being said, we're willing to help anybody in your network that needs help, whether they just have a question, they want some advice, whether we work with them or not. We're always here to help anybody that you'd like us to help. So we appreciate the question, and we'd love some new clients. That'd be great.
Yep, we do take new clients. We deal with a relatively small number of families, so we have more capacity, but we want to, I guess in the end, we want to grow the business in a smart way, but also with people like you, people that we love to work with. That's a long-term relationship. So, we're not interested in growing just for the sake of growing, but we are interested in finding new people like the people we work with. So
that's right.
Yep.
We appreciate you all taking a half an hour with us, and happy holidays. Enjoy time with your families, and hope you all do something fun.
Yep. Reach out with any questions. Happy New Year, happy holidays, and thanks for a good year.
Yeah, it was a great year.
Yep.
Appreciate it. Bye.
Bye.